Friends, have you ever noticed that some traders perform consistently well in one market, but the moment the market changes, their confidence suddenly disappears? The strategy is still the same. Their knowledge hasn't changed, yet somehow the results start falling apart. Why? Because many times, the problem isn't the market itself. The real problem is that the trader simply isn't built for that particular environment. Hello traders, I'm Priya and welcome back to your own channel. Today we're going to understand lesson 19 from the book The Daily Trading Coach. In trading, every person thinks differently. Some people enjoy making fast decisions. They feel alive in high-speed market movement. Others prefer patience. They perform better in calm and structured conditions. Some traders rely heavily on charts and numbers, while others trade more through intuition and price behavior. And interestingly, markets also have personalities. Some markets are extremely aggressive, where every minute feels mentally exhausting. Some are slow and stable, where patience becomes the biggest advantage. In some markets, emotions drive everything, while in others, logic and data dominate the game. Now think about this. If a naturally calm trader starts trading in a highly aggressive environment, at first they may force themselves to adjust. But slowly confusion starts building inside. You begin questioning everything. You can't understand what exactly is going wrong. Then that confusion slowly turns into frustration, and eventually, a point comes where you start doubting your own abilities. You begin to feel like maybe you're the problem. But the truth is, many times the person is not wrong. The environment is. And that's exactly why successful trading is not just about strategy. It's about understanding yourself, understanding your personality, and choosing an environment where your mind can naturally perform at its best. In this lesson, we'll understand how choosing the right trading environment can completely transform your performance, confidence, and consistency. Friends, every trader enters the market with the same goal, to make profits. But not every trader sees the market the same way. Looking at the exact same chart, one trader decides to buy, while another decides to sell. Why? Because every trader thinks differently. Let's imagine two traders, Aditya and Rohan. Aditya prefers markets that are moving strongly in one direction. The moment he feels a powerful trend is beginning, he jumps in and trades with that momentum. If the market is moving upward, he looks for buying opportunities. If the market keeps falling, he starts searching for short selling setups. His mindset is simple. When the market is clearly moving in one direction, it's safer to move with the trend rather than against it. In other words, Aditya likes trend-following trading. Now Rohan thinks very differently. When the market rises too much, he starts thinking, maybe the move is becoming exhausted and the market could reverse from here. And when most people are panic selling, that's when he starts looking for buying opportunities. He believes that some of the best opportunities appear when everyone else is driven by fear. So even though both are traders, they see the market through completely different lenses. And that's one of the most fascinating things about trading. There is no single perfect way to trade. Some traders love making fast decisions using charts. They enjoy reading patterns, candles, and breakouts. Others trust numbers and data more. They prefer statistics, reports, and analyzing market behavior logically. That's why trading is not just a strategy game. It's also a personality game. Now let's talk about time frames. In simple words, how long you hold a trade. Some traders enter and exit trades very quickly. These traders are called scalpers. They can enter and close a trade within just 1 to 5 minutes. Sometimes they take multiple trades in a single day because their focus is on capturing very small price movements. But scalping is not easy. It demands an extremely fast mind. You have to make decisions within seconds, maintain complete focus the entire time. And without strong discipline, surviving in this style becomes very difficult. Now let's talk about intraday traders. These traders become active the moment the market opens, and they close all their positions before the day ends. In other words, their entire game starts and finishes within a single trading day. They constantly need to watch the screen, because even small market moves matter to them. But one advantage is that they avoid overnight risk completely. Now let's move to swing traders. Their mindset is very different. They don't rush into trades. Sometimes they hold a position for 2 or 3 days, and sometimes even for several weeks. Their focus is not on tiny price movements, but on capturing bigger market swings. That's why patience becomes extremely important in swing trading. Now let's talk about portfolio managers. These people don't depend on just one stock or a single trade. Instead, they spread their money across different assets. Their main focus is balance and long-term growth. Most of their decisions are based on the bigger picture of the market, not short-term noise. Now here comes the most important point, friends. Not every trading style is made for every person. If your personality is naturally calm and you prefer working without constant pressure, then scalping can mentally drain you, because there, decisions have to be made every few seconds. On the other hand, if you are naturally a fast thinker, someone who enjoys quick action, but you choose swing trading instead, then after some time, boredom may start creeping in. The market will move slowly, your patience will start breaking down, and you may end up closing trades too early. That's why successful trading is not just about strategy. Real success comes when your trading style, your time frame and your personality all work together in alignment. Friends, now let's talk about one of the most important parts of trading, and that is how a trader actually makes decisions. When to enter a trade, how much quantity to buy, where to place the stop loss, and when to finally take profit and exit. These decisions determine whether a trader survives in the long run or ends up making emotional mistakes. Now here's the interesting part. Every trader has a different way of making decisions. And this is called a decision-making framework. Let's understand this in a simple way. The first type is the discretionary or intuitive trader. Imagine a trader waking up in the morning, checking the news, opening the charts, and simply observing the market. After watching for some time, they start feeling that today the market looks a little weak, or maybe buyers don't seem very confident right now. And without doing too much calculation, they directly enter a trade. Why? Because they trust their experience and gut feeling. Their decisions are not driven by a fixed rule book, but by the feel they develop while reading the market. But here's the problem. If emotions enter the picture, or that feeling turns out to be wrong, the losses can become very large. Because the decisions are not coming from clear rules, they are coming from mindset and emotions. Now let's move to the second type, the analytical and structured trader. This trader works very differently. They prepare everything in advance. Before the market even opens, they already know where the support is, where the resistance is, where volume increased, and what signals the indicators are giving. Everything is planned beforehand. Then the next day, they simply follow that plan. For example, if price breaks above this level, I'll buy. If price falls below this point, I'll exit. So here, decisions are not based on emotions, they are based on logic and data. And the biggest advantage of this approach? Less confusion, stronger discipline, and fewer impulsive decisions. But this style also has a weakness. If the market suddenly behaves differently from the plan, this trader can become confused. Because sometimes the market doesn't move according to rules, it moves according to surprise. Now let's talk about the third type, the hybrid trader. This is a mix of logic and intuition. These traders create plans, analyze data, but during execution they also stay connected to the feel of the market. If they sense that market behavior is suddenly changing, they adjust their decisions accordingly. In other words, they don't depend completely on emotions, but they also don't trap themselves inside rigid rules. They try to maintain balance between both worlds. Brett Steenbarger also shares a very interesting idea. He says, I build my strategy in advance, but while taking entries and exits, I also use intuition. And that's exactly what makes trading so personal. Because every trader's mind works differently. Some people become emotional very quickly. These traders usually need a strong system, something that keeps them disciplined. Because when rules are unclear, emotions take control very fast. On the other hand, some people are naturally calm and logical. They can stay composed even under pressure, which allows them to perform well with a little more flexibility. Some traders are naturally fast decision makers. For them, short-term trading or scalping may feel more comfortable. And then there are people who think slowly, who prefer analyzing everything calmly and carefully. For them, swing trading or long-term investing often feels more natural. Now here's where most traders make a huge mistake. They blindly copy someone else's strategy. Let's say a YouTuber shares a trading setup. He says, when RSI goes below 30, look for a buying opportunity. And when RSI crosses above 70, consider booking profit or looking for a sell opportunity. So you copy the exact same strategy. But you never stop to ask yourself, does this strategy actually match my personality? And then what happens? RSI drops below 30, you enter the trade, but after that, the price keeps falling even more. Now fear starts kicking in. Your mind begins saying, what if this turns into a huge loss? And in panic, you exit the trade halfway. Now the problem was not the strategy itself. The real problem was that the strategy did not fit your thinking style. That's why finding a profitable strategy alone is not enough in trading. The real game begins when your strategy and your personality start working together. How do you react under pressure? Do losses emotionally break you, or do you stay calm? Do you prefer quick decisions or patient execution? Your strategy should be built around these answers. So always remember, don't blindly copy in trading. Understand yourself, understand your psychology, and then customize your strategy accordingly. Friends, now let's talk about a mistake that many traders keep repeating again and again. And that mistake is trading outside your natural style. Now here comes an important word, niche. In simple terms, your niche is the trading style that naturally matches your personality, your strengths, and the way your mind works. It's the approach where you feel the most comfortable and confident. Now think about this. Suppose a trader normally enjoys calm swing trading, but one day, out of excitement or emotion, they suddenly start scalping. What happens then? At first, it may feel exciting. But after some time, the mind starts feeling pressure. Because in scalping you have to make decisions every few seconds. And if someone is not mentally built for that speed, stress slowly starts building up. The exact same thing happens in trading. When you trade outside your natural style, not only does the strategy start breaking down, your psychology also becomes unstable. Brett Steenbarger also says something very powerful. Many traders experience confusion, stress and losses, not because the market is bad, but because they are trading against their natural strengths. In other words, you may be trading a strategy that you don't truly understand deep inside. Or maybe you've chosen a time frame that mentally exhausts you. And when something doesn't match your personality, your performance slowly starts falling apart. That's why every trader must find one thing, their sweet spot, that trading style, that setup, that market environment, where they feel naturally stable, where decisions don't create unnecessary stress, where logic feels clear and instinct also feels aligned. Because that becomes your real edge. And always remember, great traders don't take every trade. They only take the trades that truly fit their personality, their psychology, and their strengths. Let's understand this with a simple example. Take Sachin Tendulkar for example. People call him the god of cricket, but have you ever noticed something interesting? He never tried to hit every single ball. He clearly understood which deliveries were inside his comfort zone, which balls carried higher risk, and how each bowler needed to be played differently. His greatness was not just about talent, it was also about patience. He didn't try to hit a boundary on every ball. He waited for the right one. And the moment he received a delivery he liked, he played the shot with complete confidence. That is exactly the mindset trading requires. Don't try to capture every opportunity, only take the trades that fall inside your sweet spot. Because every trader has a natural sweet spot. A certain market environment, a certain time frame, and specific setups where they naturally feel more confident and clear. Some people perform better in fast-moving markets, while others do better in slow and stable conditions. Some traders thrive in breakout setups, while others perform better in reversal trades. But the moment you start trading outside your natural zone, your performance slowly begins to decline. Confusion increases, stress increases, and your decision-making becomes weaker. That's why becoming a successful trader is not about learning every setup in the market. The real skill is knowing what your strongest game truly is. Brett Steenbarger shares a very powerful insight here. He says that many times our emotions themselves give us signals that tell us whether we are trading inside our natural zone or moving away from it. If while trading you constantly feel frustrated, confused, or internally anxious, then there's a chance you are forcing yourself into a trading style that simply does not match your personality. But on the other hand, if your mind feels calm while trading, your focus feels clear, and your decisions feel natural, then that may be a sign that you are finally trading inside the right niche for you. And friends, this idea is not limited to trading alone. This rule applies to almost every area of life, whether it's your career, your relationships, or your daily routine. When your work matches your skills and interests, you naturally begin to grow. Learning feels exciting. your energy stays high, and internally you feel satisfied. The same thing happens in relationships too. When someone understands your values and respects your personality, the relationship naturally becomes stronger over time. But when the environment doesn't match your nature or your needs, an inner discomfort slowly begins to grow. And many times, that discomfort itself is a warning signal. Negative emotions are not always bad. Sometimes they simply come to tell you, maybe you are operating in a place that was never truly built for you. So always remember these three things. First, identify your sweet spot. Second, don't ignore your emotions. Observe them like signals. And third, before every trade, ask yourself one question. Is this setup truly right for me? Because great traders don't take every trade. They only take the trades that fit their strengths, their psychology, and their comfort zone. And friends, this is where the real skill of self-coaching begins. Now think about this. If you were your own coach, what advice would you give yourself? A good coach does not push you to take every trade. A good coach understands the conditions where you perform at your best. And when emotions push you toward the wrong setup, that same coach stops you. Trading requires the exact same mindset. It's not enough to simply know when to take a trade. Real maturity begins when you start understanding when not to trade. Because most mistakes happen right there. Sometimes you trade out of boredom. Sometimes you switch strategies because of FOMO. And sometimes, after a loss, you fall into revenge trading. And slowly, the trader drifts further and further away from their core zone. So friends, now let's come to a very important question. Brett Steenbarger says, every trader should know their wheelhouse. Now what does wheelhouse actually mean? In simple words, it's that trading style, that setup, that time frame where you feel the most naturally comfortable. Where decisions don't feel forced, they feel clear. Now ask yourself a few questions. If you could trade only one strategy, which one would you choose? If you were allowed to trade only one time frame, which one would suit you the most? And if you had to focus on only one market, where have you performed the most consistently? Now think honestly. Do these answers come to your mind immediately? Or does confusion begin? Because if it takes too long to answer, there's a good chance you still haven't clearly defined your real niche. And this is exactly where most traders make mistakes. They keep trying every strategy, keep chasing every new setup, but never pause long enough to ask, what is actually working for me? Brett Steenbarger also says that until you honestly review your past trades, you'll never truly understand which setups are your real strengths and which trades are only creating unnecessary stress. Some trades feel natural, your decisions feel clear, execution feels smooth, and your mind stays stable. But there are also trades where doubt appears every single time. The moment you enter, fear begins. You feel like exiting too early, or constant frustration starts building up. And many times, these are the signals telling you that the trading style may not match your natural personality. That's why becoming a successful trader is not about learning every setup in the market. The most important thing is knowing clearly, what is my strongest game? Now here comes another very important question. Can a trader expand or grow their niche? Absolutely. But the problem begins when people suddenly jump into a new strategy without proper preparation. So what's the right approach? Evolve slowly. Just like a company doesn't launch a new product everywhere immediately. First, it tests the product on a small scale. It observes the results, studies the response, and only then expands gradually. Trading works the exact same way. If you are learning a new strategy, don't start trading it with full capital immediately. First, test it with small size. Do back testing, observe market behavior, and most importantly, see whether that style truly matches your psychology or not. Because not every profitable setup is profitable for every person. Some strategies may look technically brilliant, but mentally they simply don't suit you. That's why growth should always happen step by step. Not through impulse, but through research. Not through FOMO, but through patience. And when over time, you genuinely start feeling, yes, this style now feels natural to me, only then should you make it part of your main trading process. And friends, this is what building your real trading niche actually means. Now here comes another powerful idea. Brett Steenbarger says, you are not just a trader, you are the CEO of your trading business. Now what does that really mean? It means your job is not only to take trades, your job is also to manage yourself, to review your performance, understand your strengths, and continuously improve according to changing market conditions. A good CEO monitors everything: what is working, what is not working, where improvement is needed, and where unnecessary risk is being taken. Trading requires the exact same mindset. The more clarity you have about your strengths, the fewer random decisions you will make. The clearer your niche becomes, the less likely you are to get distracted emotionally. Because trading is not just a game of charts and indicators. The real game happens inside your mind. When you trade inside your sweet spot, confidence naturally increases. Your emotions stay more stable. And most importantly, you avoid unnecessary overtrading. So always remember, great trading does not begin when you start trading every setup. Great trading begins when you consciously start trading according to your strengths. So friends, today's lesson teaches us something extremely important. Success in trading does not come only from strategy. It comes from understanding yourself. The moment you begin understanding your personality, your psychology, and your natural strengths, that's when your real growth begins. Because in the long run, the traders who survive are the ones who learn how to trade according to their own style. So don't blindly copy others. Don't chase every single trade. Identify your sweet spot, improve it, and slowly become a master of it. And friends, if you learned something valuable from today's video, then make sure to hit the like button. Honestly, your likes and comments give a lot of motivation, and they let me know that these videos are genuinely helping you. And if you want to learn more about trading psychology and self-improvement, then subscribe to the channel and press the bell icon as well. I'll see you in the next lesson. Till then, stay disciplined, stay patient, and trade smart.